Wednesday, February 14th to order. Today we will have a continuance of the hearing on Senate Bill 495. We will resume to oral proponent testimony. We have Kelly Vanzewell with the Kansas Bankers Association committee. I will tell you, she seems to be extremely nervous once again to testify, and she has asked me to ask you to be really nice to her today. So, Kelly, welcome.
Good morning, Mr. Chairman, members of the committee. Thank you for the opportunity to testify today, and thank you for being here. I mean, Super Bowl parade, UCCC hearing, close call. I'm Kelly Vanzewell, Vice President of Government Relations for Kansas Bankers Association. You know my colleague, Alex Orrell, but I have another colleague with me as well today, Jamie Cosgrove. She's the Vice President of our legal department, so she's here as my backup. Eileen and the revisers, I just want to say thank you so much for all of your work on this bill. I know it was a big lift and I know it was a lot of work and we're really appreciative of that. The revisers and the OSBC did a great job of their summary yesterday, so I won't go into a summary of what the UCCC is. I'll just kind of focus on the changes that the KBA brought to the working group. As we mentioned, there was a big group that came together to kind of think of what do we need to do to this bill, to this section of law. It hasn't been really touched since the 1999, so there were a lot of changes we needed to make. And the KBA was really focused on changes that would bring our state law kind of back into alignment with federal law and other state law changes that had been made so that we have kind of a matching system here. The first change I'll focus on was the change that allowed the finance charge rate for a consumer loan to move from a blended rate to a flat rate of 36%. This is only for closed-end, non-real estate loans. So an example of that would be maybe a car loan. The moving to a flat rate of 36% will make it easier for lenders, auditors, and regulators to calculate, and it will also make it easier for our systems. So as they mentioned yesterday, the UCCC was supposed to be uniform, but only 11 states adopted it, and they each kind of do their own thing, so there is no uniformity to it. And we have found that our bank operating systems have a very difficult time holding federal, that's a point for a different part. Excuse me. Okay, many states have moved from the blended rate to the 36%, so it's a lot easier for them to calculate. It'll make us more competitive with our surrounding states who have moved away from the blended rate to the flat rate. Some states don't even have a flat rate. For example, Missouri has no rate. It's just whatever they contract. 18 other states have a rate of 36% and above, so it will make us more competitive in that way. And moving to this rate will make it easier for financial institutions, and it will increase our likelihood that we'll be doing more of these loans. So it will give people with lower credit another financing option. The next change I'll focus on is resolving the discrepancy between federal law, which is the Truth in Lending, or Regulation Z, as I'll call it, between Regulation Z and the UCCC when it comes to the prohibition against the pyramiding of late fees. Both rules have a rule that prohibits the pyramiding or the stacking of late fees, but Regulation Z and UCCC have slightly different rules. This is where I was making my point of it's very hard for our bank operating systems to hold both of those rules in place. It's hard for them to kind of label which loan is a UCCC loan and follows this late fee rule, which loan is a Regulation Z loan and follows this late fee rule. So moving to one same rule, the Regulation Z rule, will make it easier for our operating systems. It will make it easier for our forms. All of our loan documents we get from forms companies, and most of the form companies just follow the federal rule. They don't account for the state variation. And it will also make it easier for the consumer because now they will just have one late fee rule and they won't have to understand, well, how come on this loan I was charged a late fee at this time, but on this loan I was charged a late fee at a separate time. Our next change is going to focus on resolving the discrepancy between the definition of earnings. There's currently a different definition for earnings in the Kansas garnishment statute than there is in the UCCC. That's because in 2021, the Kansas Supreme Court heard a garnishment case that impacted the creditor's ability to garnish funds that are in a deposit account if they are earnings. In response to that case, in 2023, the Kansas Legislature passed House Bill 2608, which amended the definition of earnings in the garnishment statute, but it did not amend the definition of earnings in the UCCC. So this will change the definition in the UCCC so that they're matching. The reason this is important, not only so that we just have a clear definition of earnings all across the statute, but in the UCCC, creditors cannot take an assignment of earnings from the consumer for payment or security of a debt. So what that really means is it affects a creditor's ability to take a CD or a deposit account as collateral on a loan. So by fixing this definition so that it matches the definition in the garnishment statute, financial institutions will be able to take a CD or a deposit as collateral on these loans without worrying about what happens if those funds are garnished. The next point is to bring the threshold for consumer loans and leases into conformance with the threshold found in Regulation Z. Again, we're just trying to match Regulation Z so that our lenders can kind of have one rule that they're following. The current threshold in the UCCC is $25,000, which was set back in '73. The price of everything has changed. It's more expensive to buy things. It's more expensive to do business. And Regulation Z, the federal law, is updated annually. So that threshold has continued to rise. So now we'll be matching the thresholds. Senator Pittman asked a question yesterday about how this would benefit consumers. And by matching these thresholds, we're going to be bringing more loans under the UCCC, which will benefit consumers because now they will have both Regulation Z and UCCC consumer protection laws covering them. Our next point is that we're clarifying a reference of days. In the late fee section of the UCCC, it just says that the late fee will be paid within 10 days, but it doesn't say if that's business days or calendar days. So we clarified that to calendar days to make it easier for everyone to understand exactly when the late fee can be applied and charged. This will also, in that section, right now in the UCCC, instead of saying late fee, they say delinquency charge, which is kind of an outdated term. Federal law uses late fee. So this section is changing that from delinquency charge to late fee, again, to match Regulation Z and to make it easier for the consumer to understand what exactly they're agreeing to. Our next change is to increase the maximum dollar amount chargeable for a prepaid finance charge for non-real estate consumer transactions. Again, this is just for closed-end non-real estate loans. Currently, you can charge the lesser of 2% of the amount financed or $100. We would like to increase the $100 to $300. This amount has not been touched since 1999. And like we've talked about, the cost of doing business has greatly increased. And due to financial institutions' increase of regulatory and legal compliance, all the IT security we have to deal with, this has all greatly impacted financial institutions. And this current limit is just not feasible when you take into consideration the actual cost it is to make these loans. An example I'll give for you, a prepaid finance charge includes the cost it is to pull the credit report on the person who's getting the loan. Back in 1999, pulling a credit report cost about $10, and today it's costing about $50. So that alone is eating up half of the prepaid finance charge. Increasing this charge will increase the ability for financial institutions to make these small dollar loans, again, giving people with lower credit or who need small dollar loans more options when they're doing their financing. The last change I'm going to touch on is eliminating the 100% loan-to-value limitations for loans guaranteed by federal government agencies. Right now, the federal government has programs where they will completely guarantee the loan, and those programs also allow the loan to exceed the 100% loan-to-value ratio. An example of those programs would be the USDA Rural Development Home Loans. So currently, we have financial institutions that participate in these programs. They make the loan. It's completely guaranteed by the federal government, and they're allowed to go over the 100% loan-to-value ratio. But under current law, anytime a loan is above the 100% loan-to-value ratio, it's now falls under the UCCC. That becomes an issue for financial institutions because it makes the loan not marketable on the secondary market. So now they're stuck with the loan on their books. They can't sell it to the secondary market. The amendment to this will allow a loan that is 100% over the 100% loan-to-value ratio, but backed by the federal government. They won't fall under the UCCC anymore. Now, typically, the reason you want a loan that's over the 100% loan-to-value ratio to fall under the UCCC is it's a little bit of a riskier loan, so you want them to have those consumer protections. But if it's backed by the federal government completely, then that risk issue is not really in question anymore. So removing this limitation only for loans that are backed by the federal government will make it so that financial institutions can sell them on the second market, and it will make them more profitable and more attractive. That's kind of my hard-hitting high points on the changes we wanted. I also included in my testimony a one-pager that we worked with the OSBC on, and it kind of gives you just a really quick summary of the changes that were made in the bill, because I know it's a big bill and there's a lot going on. I did want to take an opportunity to answer Senator Fagg's question yesterday about mixing cross-collateral. We spoke with the OSBC, and we don't believe that would be an issue here. Just because the mortgage provisions are moving into the KMBA, you'll still be able to mix the collateral. It won't change any of that process. You can still do cross-collateralization agreements. Thank you, Mr. Chairman, committee members. I'm happy to stand for questions.
Thank you very much. Couple of points of clarification. Number one is you testified that we haven't had a major change since 1999. I believe you were in kindergarten.
I was, thank you. And the changes in 99, actually to clarify, were not even major, I would say. They introduced it in 73, they did some cleanup in 99. But yes, I was in kindergarten.
I guess it's time.
I think so.
Second point is we had testimony yesterday, and then you hit on it in your testimony is establishing or going away from the blended rate and going to a cap of 36%. I want the public to understand that that is a cap. That is not the market rate.
Correct.
And the market will determine what that rate is based on competition and creditability and the individual borrower. So I don't want people to think that all loans are going to be automatically 36% because the market will determine that. Is that correct?
Yes, that's correct. Thank you for clarifying that point. It is just setting the max that it can go up to.
Committee, are there questions for Kelly? Senator Fagg.
Thank you, Mr. Chairman. And Kelly, thank you for your presentation. This kind of goes around late fees. If a person comes in, they have a $400 payment and they're late, and you're going to assess a late fee, is it like 5%, or is there a set number out there? Does a regulation hit to that?
I don't believe the regulation sets the late fee, but let me double check. Yeah, I don't believe I can double check for you. I don't believe it's set in here what the late fee can be. What we're talking about is the calculation of how many days they have until a late fee is charged.
And then my second question would be, if a person makes a payment for $400 and they can only pay $100, do you collect late fees first out of that $100, or can they come in and say, I want this to go on my payment?
Are they going to just the current payment that they're missing? Is that what you're asking? So
They dictate where the money goes. That's my question.
I believe that the money goes to the loan payment, and then the late fee is still on top of it, but I will double check that for you.
If they don't have enough, the question is, which one does it go to? That's my question.
I believe it goes to the actual loan amount, but I will double check that for you.
I think I see some nods from the OSBC that may be correct.
Perfect. Like when I have a team behind me here.
Additional questions for Kelly? I see none. Thank you very much for your testimony.
Thank you.
Committee, we will now turn to Ryan Black, who is the Vice President and Government Relations Manager for One Main Financial, and he is joining us via WebEx this morning. Ryan, are you with us?
Yes, I am, Chairman. Can you hear me?
I can.
Okay, thank you. Good morning, Chairman Longvine, members of the committee. Thank you for this opportunity to offer remarks in support of SB 495. I wish I could be there with you in person today. Unfortunately, I am at a conference. So thank you for this opportunity to participate via WebEx. So my name is Ryan Black. I serve as Vice President and Director of Government Relations for One Main Financial. One Main Financial is a community-based licensed lender that proudly serves the financial needs of over 17,000 Kansans today. One Main has 11 branches in Kansas, and we employ nearly 50 team members. Nationally, we offer our personal installment loans in 44 states from around 1,300 locations. On behalf of One Main, we thank you for the opportunity to offer this support for legislation that will modernize various aspects of the Uniform Consumer Credit Code. Lending laws have been modernizing across the nation to allow more people safe access to responsible and affordable loans, while bringing these laws into the 21st century. The changes in SB 495 will give the Office of State Bank Commissioner the improved ability to effectively regulate while helping expand access to affordable local credit for Kansans. And all this can be done without sacrificing any of the consumer protections that are essential to the credit market. The changes in this bill will allow a new tier of borrowers to receive loan offers in state from lenders like OneMain, loan offers that these consumers are not receiving today. We do value very much the work done by OSBC and the Kansas bankers and fully support the efforts here as it pertains to streamlining and enhancing the regulation of our industry. We respectfully urge your support of SB 495. Thank you again for the opportunity to comment on this matter, and I would be happy to answer any questions.
Ryan, thank you very much for your testimony. Commissioner, are there questions for Ryan? I see none. Thank you very much.
Thank you.
We will now call on Whitney Dameron with Kansas Community Financial Services Association, Inc. Whitney, welcome.
Thank you, Mr. Chairman, members of the committee. No admonition to be kind to me forthcoming, I guess, but that's okay. I appreciate the opportunity to be here. The chairman mentioned the last time we did a UCCC recodification was 1999. That coincidentally or not is the same year that the organization that I represent was formed. So they have been involved in this issue for nearly 25 years. We come to you today in support of Senate Bill 495, and we specifically, point to the sections that deal with KSA 16A2-404 et sec, known as payday loan sections. The group that got together invited us to participate, and a number of people who make small dollar loans were at meetings held at the Kansas Bankers Association and talked through the bill and the sections that apply to those of my members. For the last probably 4 or 5 years, we've had discussions with people on reforms to payday loans, small dollar loans, and one of the issues talked about has been some kind of an off-ramp or an extended payment program. Other states have had these options for consumers. We have proposed them in the past. They also are part of the Consumer Financial Services Association best practices, which is an association of national lenders that are in this space. We worked with OSBC. We appreciate their willingness to work with us to put together language that you see in this bill that was modeled after Wyoming law, but there are a number of other states that have these kinds of provisions as well. Specifically, if a consumer chooses to exercise this option, they approach their lender at least by close of business the day before their loan comes due. They have an option to repay their balance in 4 installments, generally over their pay period every couple of weeks or so. There's no prepayment penalties, and there's no additional fees charged to them. We think this is going to be helpful to the consumer. We have proposed similar statutory provisions to help the consumers in the past that have been led by our organization. If you look at existing law, there is no criminal prosecution for writing bad checks. There's 24-hour right of rescission. Contracts are available in Spanish as well as English and so forth. And we also had supported the military provisions that are included in the bill as well. We're aware that there might be critics who think this doesn't go as far as they would like it. We have engaged with them over the years, and we know they've also supported other legislation that included provisions for what I refer to as the 36% loan option, which was highlighted in Kelly's presentation to you. That's included in Section 49 of the bill. They've supported those provisions. We do as well. It doesn't really affect our members, but it does create additional borrowing opportunities for customers. And we think that providing additional competition for the borrower is helpful as well. So with that, Mr. Chairman, we do stand in support of this bill and the sections that we cite, and we'd be happy to stand for questions for you and the committee. Thank you.
Whitney, thank you very much for your testimony. Committee, are there questions? Senator Fagg.
Thank you, Mr. Chairman, and Whitney, thank you for your presentation. You talked about that 4-month time if they come in before it's due, and you said no other fees. You still collect interest during that 4 months, don't you? The remaining balance?
It's the fee of whatever was contracted for, so all additional fees stop.
At that point?
Yes.
All right.
Committee, additional questions? I see none. Thank you, Whitney.
Thank you.
I would like to point out proponent written-only testimony from Sean Miller, President and CEO of the Community Bankers Association, Pam Scott, Executive Director with the Kansas Funeral Directors Association, and Michael Murray, Executive Director of the Kansas Credit Union Association. We will now turn our attention to neutral oral testimony. We have Martha New Smith, Executive Director with the Kansas Manufactured Housing Association. Martha, welcome.
Thank you, Chairman Longbine and members of the committee. I am Martha Smith. I'm the Executive Director for Kansas Manufactured Housing Association, and I appreciate the opportunity to talk to you today about our concerns regarding just personal property manufactured home loans. And those are the loans that are used for all of our homes in manufactured home communities, like South Village, Bonner Springs Estate, all of those communities, those homes they have loans on them that are personal property. They do not include any real estate. Under Senate Bill 495, prior to 495, we were covered by the UCCC. And in my testimony, I put the pages and the lines that have been stricken. But as you can see, under the UCCC, it was specifically spelled out that the consumer loan secured by an interest in a manufactured home. When you go over to the MBA, manufactured or mobile homes are not mentioned. Now, the department does feel like we're covered. They feel like the definitions, let's see, on page 11 of mortgage loan, and the federal citation of 15 USC 1602W covers mobile homes. And then since it's in that definition, we would be under, let's see, page 11, covered transactions. Our concern is that we're not sure that if all of us are gone, lobbyists come and go, people change jobs, will there be a way to track that through? We have contacted the OSBC. They said they're more than willing to work with us, and in fact, we've already received some language. They initially thought going through the rule and reg process might be the way to go. Our concern is this bill goes into effect January 1st of next year. We've gone through the rule and reg process before. Sometimes that can take over a year. But the department or the OSBC has said that they would be willing to work with us on either an administrative order or a standing order, which they say has the same weight as law does. So we would be willing to work with them to get that clarity that we had before under the UCCC. Hopefully that explains it.
It does. Martha, thank you very much, and I do appreciate your willingness, and I understand your concerns. I think we have a difference of opinion of a bunch of lawyers, which often happens.
Absolutely.
OSBC has assured me that they don't feel that there'll be any changes in how your industry is treated, but they have been willing to, through rule and reg or an administrative order or something like that, to give you further clarity and certainty. So
We appreciate
I'm happy to hear that. And,
yes.
I'll be monitoring that progress as we work through this.
Thank you.
Are there questions? Senator Warren?
Thank you, Mr. Chair, and thank you for being here, Martha. I appreciate your testimony. So for the audience who's maybe watching at home, could you explain what the issue is that if you're not able to use the manufactured home because it's personal property as collateral for a mortgage, or what? And maybe I haven't stated it right, but how does that impact a Kansan who is trying to finance the purchase of a manufactured home or otherwise use the manufactured home as collateral for another loan. Could you just explain that a little more clearly?
I'll try to.
Thank you.
These type of loans are home loans, are chattel loans, or personal property loans. They include no real estate, so they don't qualify for a mortgage. They only qualify for a consumer loan. And that consumer loan, then, I mean, their lien is stated on the title of the personal property versus a mortgage recorded at the Register of Deeds. Is that kind of?
Yes, because real property liens and
Right.
are recorded at the county recorder of deeds or register of deeds office, and your car loan is just recorded on
Lien on the title.
on the title of the car. Yes,
Right.
you're both named as co-owners of the car, so it's harder than. And then what's the fallout from that? Well, then you can't go look up who has a lien on the manufactured home because it's not recorded anywhere, is kind of the
It
fallout.
wouldn't, well, the department seems to think we're still covered, but right now, the lien is recorded on the title, and you can do a title search and find out who is on that title and who has a lien.
And so then the problem is,
Well, there's no problem yet.
Okay,
We're trying to avoid a situation where we're not sure where we're covered, and since the UCCC is gone for us, and we're supposedly covered under the MBA, but under the MBA, it does not spell out manufactured or mobile home are covered under their, what we call chattel loans.
okay, and that's why the further discussions are going to be had. And serving as chair of the Joint Committee on Administrative Rules and Regulation, one of the issues that comes up often in rules and regulation is, well, maybe this is a policy decision for the legislature and not for rules and regulations. So I'm not suggesting that in this case, but if it's going to be, it would be coming through that committee for the committee to hear. And so just, I encourage the stakeholders to get together and continue those discussions, which I appreciate that the chair is working on with, and the stakeholders are working on it too. So thank you for bringing that to our attention. Thank you, Mr. Chair.
Thank you.
Senator Fagg.
Thank you, Mr. Chairman. Martha, thank you for your presentation. If you have a repossession go on here in the future, will this rules and regs cover this kind of thing?
Since it has the same force of law, I would guess, but that would probably be a question for the bank commissioner's office.
Okay, that's one I would be questioning just through this period of time. You're going to have that issue come up probably somewhere, so that would be one. The other one I can tell you in the past is that you have your manufactured home that has a title.
Right.
You go under that law. And then you got the property you own that goes under a different law. And then you got a period of time where you can surrender that title and have it become mortgage. So that's a complicated deal.
It is
when you get into it. So I hope we do a good job addressing that, is what I'm saying.
Thank you.
Martha, I don't see any other questions. Thank you very much.
Thank you.
Committee, let me call your attention to neutral written only testimony from Chuck Weber, Executive Director of Kansas Catholic Conference. At this point, I do not have any opponent testimony. Is there anyone in the audience who would like to testify either as a proponent, neutral, or opponent to the bill?
Sorry, committee. Thank you, Kelly Vanzwall with Kansas Bankers. I wanted to clarify on a question Senator Fagg answered earlier, if that's okay, Mr. Chairman.
Proceed.
Thank you so much. You asked about setting the late fee. It is set in statute, but we didn't change that portion. We were just talking about the days that you count to when you can actually insert the late fee. Thank you.
Thank you very much. Committee, we will close the hearing on Senate Bill 495. Once again, I want to thank all of the stakeholders for their work, and I especially want to thank the OSBC and Eileen for working on this massive bill. It's only 103 pages, but it was a very complicated bill to write, and so I certainly will my gratitude is out to those that worked on it. Okay, committee. I have a little history in incentives and motivating people. So here's your challenge. We're going to work bills tomorrow, and I have 11 of them stated. And so if we work 11 bills tomorrow, then we will not work on Friday or Monday or Tuesday. But if we don't complete 11 bills tomorrow, then we'll have to figure out which one of those days we're going to work. So once again, if you, we have 2 amendments to bills that were presented in testimony. We have those prepared. There are no other amendments that I'm aware of, but if you do have amendments, I need you to get with Eileen immediately so that she can have those prepared for tomorrow. We'll hope for a big day. 11 is too short of the record in this committee, so I don't have any fear that we can't accomplish that and take a couple of days off. So anything else? All right, we're adjourned.